Recording in progress.
All right, welcome to today's webinar, guys, and we'll be talking on trading essentials. We have been on the series, now we're in chapter 4 of trading essentials, and understand much about this platform. Ztradex, we currently offering 500 times leverage. So in case you haven't gotten yours, I think it's a good time for you to do that. Log into your portal, make a deposit, and it runs up to the end of the month. So please do make sure you grab your own part of this and make sure you enjoy wonderful, wonderful benefits. So now, without wasting much of our time, we need to understand something perfectly here. If you're having problems, issues in your trading series, it's very essential that you understand each and every of the courses you're taking because they're very vital for people who don't understand much about the market and want to maximize their profit potentials and make consistent profits from this. So it's very essential that we all follow suit and keep working to make sure we improve our trading strategies and all of that. So with all that being said and done, without no further ado, let's begin the course. Today, we'll be looking at more and more strategies. Last time we talked about stop loss inputs, risk management tips. Today, we are looking furthermore into risk management tips to help you ensure that you are able to protect your account from bad trades and also maximize your profit potential with good trades. So let's begin. Next page, please. Now, risk management, for instance, let's just break it down a bit. It takes money to make more money, and everyone knows that. But how much do you need to get started in trading? The simple answer likely depends on how you're going to approach your new trading business. It varies from person to person. Drawdowns are a reality and will always happen to you at some point. And of course, the more you lose, the harder it is to make it back to your original account size. And this is all the more reason that you should do everything you can to protect your account. Now, we hope that it's been drilled into your head that you should always risk a small percentage of your account on each trade so that you can survive your losing streaks and also to avoid the large drawdown in your account. Now, the less you risk on a trade, the less your maximum drawdown will be. And the more you lose in your account, the harder it is to make it back to break even. This actually means that you should only trade only a small percentage of your account. And of course, the smaller the better, smaller the better. Next page, please. Yep. Now, 2% or less is actually recommended. As we all know, they say that less is more. So 2% or less per trade is a highly recommended guideline for everyone to follow. We stress about guidelines because it depends on all the factors besides your experience, like your trading system, mainly how often it takes a trade. The more currency trades you take per time frame that you're focused on, the less you want to risk per trade. And also don't forget to factor in changing market volatility and any adjustments to your entries and your exits. You understand? So ignoring leverage is one hell of a way not to make profits. Most professional forex traders and money managers trade one standard lot for every $50,000 in their account. And if they traded a mini account, that means that they trade one mini lot for every $5,000 in their account. So best we understand this purposefully. So next page, please. Now, if pros trade like this, why do less experienced traders think they can succeed by trading 100K standard lots with $2,000 account or $10K mini lots of about $250? Now, no matter what the forex brokers tell you, Don't ever open a standard account with just $2,000 or a mini account with $250, because some even allow you to open accounts with just $25. And the number one reason new traders fail is not because they suck, or because they are undercapitalized from the start and don't understand how leverage really works. So don't let yourself up to fail. And we recommend that you have at least have $100,000 of trading capital before you open a standard account. Okay, and $10,000 for a mini account or $1,000 for a micro account. And of course, you open an account only when you are consistently good in making profits. And so if you only have $60,000 account, you open a mini account. And if you have only $8,000 account, you open a micro account. As simple as that. And if you have only $250, you open a demo account and stick with it until you come up with additional $750. Then open a micro account if you have $1. Now, if you don't remember anything else in this lesson, at least remember what you need to read above, which is always understand how leverage really works. Don't set yourself up for failure. And we believe that most new traders who open a forex trading account would be a minimum deposit do so because they don't completely understand what the terms leverage, margin, and the rest of it, and how it actually affects their trading. Okay, next page, please. It's crucial that you're fully aware and free of ignorance of the significance of trading with leverage. But if you don't have a rock solid understanding of leverage and margin, we guarantee that you will blow your trading account. Now, what is leverage? I think that's the question on everyone's lips who is joining. You've been hearing a lot about leverage this, leverage that. We know that we tackled this quite before, but this topic is very important. And this is one of the reasons why Supercore is currently offering clients, ZTradex, I mean to say, currently offering clients 500 times bumper leverage. Now, the textbook definition of leverage is having the ability to control a large amount of money, using none or very little of your own money, and borrowing the rest. Or for example, to control a $100,000 position, your broker will set aside $1,000 from your account, and your leverage, which is expressed in ratios, is now 100 to 1. But you're now controlling $100,000 with just $1,000. And let's say the $100,000 investment rises in value to $101,000 or $1,000. And if you had to come up with the entire $100,000 capital yourself, your return would be a penny, say a penny of $1, $1,000 gain per $100,000 initial investment. Now, this is also called leverage, 1:1, of course. I think 1:1 leverage is a misnomer, because if you have to come up with the entire amount you're trying to control with the leveraging that, fortunately, you're not leveraged to 1:1, you're leveraged to 100 to 1. And the broker only had to put aside $1,000 of your money, so your return is a groovy 100%. So we're talking about a $1,000 gain per $1,000 initial investment. Now we want you to do a quick exercise to calculate what your return would be if you lost $1,000. But then if you calculated it the same way we did, which is also called the correct way, you could have ended up with minus 1% return using 1:1 leverage, and your 100% return using 100 to 1 leverage. What's the next page, please? Margin. Now, margin is another important word when it comes to trading on the financial market. So you might be wondering, what about the term margin? Now, for example, in Forex, to control a $100,000 position, your broker will always set aside $1,000 from your account, and your leverage, which is expressed in ratios, is 100 to 1. And you are now controlling $100,000 with $1,000. And the $1,000 deposit is said to be your margin, because you had to keep it in order to use leverage, right? Now, margin is simply the amount of money needed as a good faith deposit to open a position with your broker, but it is used by your broker to maintain your position. Your broker basically takes your margin deposit and pulls them with every margins deposit and uses this one super margin deposit to be able to place trades within the interbank network. Now, margin is usually expressed as a percentage of the full amount of the position. And for example, most forex brokers say they require 2%, 1%, 5%, or 25% margin. Now, based on the margin required by your broker, you can calculate the maximum leverage you can wield with your trading account. Now, this leverage tastes so yummy, it gets you very, very hyperactive and very happy. Of course, that's the word. And if your broker requires 2% margin, you have a leverage of 50 to 1. And there are other leverage flavors that most brokers offers, but Ztradex offers you, of course, the very best, from the minimum 1:20 to the maximum 500 times plus, which is of course a win-win for all our clients. Next page, please. Aside from margin required, you probably see other margin terms in the trading platform. This is much more confusion about what these different margins mean. So we will try our best to define each and every one of them. Margin required, used margin, usable margin, one after the other. First, margin required is an easy one because we all just talked about it. And it's the amount of money your broker requires from you to open a position. And it is expressed in percentages. Now, we talk about account margin. This is just another phrase for your trading bankroll. And it's the total amount of money you have in your trading account. Then we talk about use margin, the amount of money that your broker has locked up, to keep your current positions open. While this money is still yours, you can't touch it until your broker gives it back to you, either when you close your current positions or when you receive a margin call. Now, we talk about usable margins. This is the money in your account that is available to open new positions, right? Now, the final one, which is the margin call, you get this when the amount of money in your account cannot cover your possible loss. And it happens when your equity falls below your use margin. So if a margin call occurs, some or all positions will be closed by the broker at the market price. Now, margin call explains more. Assuming you're a successful retired British spy who now spends his time trading currencies, you open a mini account and deposit $10,000, and when you first log in, you see the $10,000 in the equity column of your account information window. Now, you talk about usable margin. You will also see that the use margin is 0.0 and that the usable margin is $10,000 as pictured below, right? Now, your usable margin will always be equal to equity less. Take, for instance, you have a balance $10,000, equity $10,000, and you have use margin, usable margin, and your usable margin equals your equity minus your use margin. Don't forget, and therefore it is the equity, not the balance, that is used to determine usable margin. While your equity will also determine if and when a margin call was reached. Okay, and finally, as long as your equity is greater than your use margin, you will not have a margin call. So equity greater than use margin equals no margin call. And also, as soon as your equity equals or falls below your use margin, you will receive a margin call. So equity equals or greater or less than use margin gives you a margin call. Then you need to go back to demo trading. So you assume your margin requirement is 1%, you buy one lot of Euro USD, your equity remains $10,000, the use margin is $100 because the margin required in a mini account is $100 per lot, but your usable margin is now $9,900. So always have this in mind, your use margin and your equity almost fall hand in hand, but your main focus should be your balance and your usable margin. Okay, next page, please. Now, if you were to close out one lot of Euro USD at the same price at which you bought it, your use margin would go back to zeros. and your usable margin will go back to $10,000. But your equity will remain unchanged at 10,000 because but instead of closing the one lot, you're having this adrenaline feeling of 79 more lots of Euro USD for a total of 80 lots of Euro USD because that's just how you roll as a trader. But you will still have that same equity, but your use margin will be $8,000, 80 lots at $100 margin per lot. And your usable margin, of course, will now only be $2,000 as shown below. So you check this out. You're seeing the balance, your equity, your use margin, usable margin, and with this insanely risky position, and you will make a ridiculously large profit if Euro USD rises. But this example does not end with such a fairy tale. So let's make or paint a horrific picture of a margin call, which occurs when Euro USD fell. But Euro USD starts to fall, you're long 80 lots. So you will see your equity fall along with it. But your use margin will remain at $8,000. Once your equity drops below $8,000, you will have a margin call. But then this means that some of or all of your 80 lot positions will immediately be closed at the current market price. But assuming you bought all 80 lots at the same price, you have a margin call which will trigger if your trade moves 20 pips against you. So we have 25 pips, we have Euro USD, and how did you come up with 25 pips? You might be wondering. Well, each pip is a mini lot is worth $1, and you have a position opening consisting of 80 freaking mini lots. But then $1 per pip, 80 lots equals $80 per pip. And if Euro USD goes up one pip, your equity increases by $80. But then Euro USD goes down one pip, your equity decreases by $80. So you have $2,000 usable margin divided by $80 per pip, which equals 25 pips. But then let's say you bought 80 lots of Euro USD at $1.2 and just your account would look like if Euro USD is about to drop, or you're having 1.195 or minus 25 pips there about. But your main focus should just be your balance, your equity, no, sorry, your balance and your usable margin in this case. Now your usable margin reduced down to a 0, and you have use margin of 8 and equity 8. So you should be having that timing on whether to place more trades or whether to wait for your already placed trades to get in profits before you close out. Next page, please. As you can see, your usable margin is now zeros, and you will receive a margin call. But of course, you're a veteran international span, you'll face much bigger calamities. But you got eyes in your veins and your heart rate still 55 BPM. And after the margin call, this is how your account will look. Zeros, 8,000s, and in reality, it's normal for Euro USD to move 25 pips in a couple seconds during a major economic data release, and definitely that much within a trading day. But we almost forgot. We don't even factor in the spreads. But to simplify things, to make things very simple, we didn't even factor spreads. Let's say Euro USD is 3 pips, and Euro USD really has a moves of 25, 20 pips, not 25 pips, sorry, for margin call. But imagine you're losing up to like $1,500, $2,000 in 5 seconds. This is what could happen. If you don't understand the mechanics of margin and how to use leverage, it's ideal you focus on your balance and also your use margin, because it all adds up to what level of leverage you should use or you should have used. Next page, please. Don't over leverage. Always remember, don't ever over leverage. Now, importantly, we need to be careful trading on margins. We have trading currencies on margin that lets you increase your buying power. And this means that if you have $5,000 in cash in a margin account that allows 100 to 1 leverage, you could trade up to $500,000 worth of currency because you only have to post 1% of the purchase price as collateral. And another way of saying this is that you have $500,000 in buying power. And with more buying power, you can increase your total returns on investment with less cash outlay. But you have to be careful because when you're trading on margin magnifies your profit and losses. All traders fear the dreaded margin call. This occurs when your broker notifies you that your margin deposits have fallen below the required minimum level because an open position has moved against you. Trading on margin can be a profitable investment strategy. The sad fact is that most new traders don't even open a mini account, yes, of up to $10,000 because you have at least $10,000, you were at least able to weather 25 pips before your ZTradex margin call. And if you only started off with $9,000 in your ZTradex account, you will only be able to weather a 10 pip drop before receiving a margin call of 10 pips. So very importantly, we need to be very focused on how we treat our margin and our margin call, of course. Next page, please. Now, we should make sure you fully understand how your margin account works and be sure to read the margin agreements. Always ask questions. Your positions could be partially or totally liquidated should the available margin in your account fall below a predetermined threshold. You may not receive a margin call before your positions are liquidated. And in the event that money in your account falls below margin requirements, and your broker will close some of or all open positions, and this can help prevent your account from falling into a negative balance, even in a highly volatile and fast-moving market. So margin calls can be effectively avoided by monitoring your account balance on a very regular basis by utilizing stop loss orders on every position, to limit your risk. The type of margin is a touchy subject, and some argue that too much margin is dangerous, but it also depends on the individual and, of course, the amount of knowledge and training he or she has been putting his or her time into. Also, if you're going to trade on a margin account, it's vital that you know that your broker's policies are on margin accounts and that you understand and are comfortable with the risk involved. You should also know that most brokers require a higher margin during the weekends. So this may take the form of 1% margin during the week, and if you intend to hold a position over the weekend, it may rise to 2% or even higher. So let the image above haunt you about the negative effects of using too much leverage and running out of margin. So hopefully we have done our job and you now have much more of a better understanding of what margin is. Now we want to take a bit harder look at leverages and show you how it regularly wipes out unsuspecting or overzealous traders' account. Next page, please. Over leveraging. Now, we have seen or heard online forex brokers advertising how they offer 2 to 1, 200 to 1 leverage or 400 to 1 leverage. But we just want to clear that what they are really talking about is the maximum leverage that you can trade with. Because remember this, leverage ratios depends on the margin required by a broker. For example, if a 1% margin is required, you have 100 to 1 leverage, and there is maximum leverage, and then there is your true leverage. But then your true leverage is the full amount of your position divided by the amount of money deposited into your trading account. So you will try to illustrate your deposit. For instance, you are depositing $10,000 into your trading account. You buy one standard 100K of Euro USD at a rate of $1, and the full value of your position is $100,000, and your account balance is $10,000. Your true leverage is going to be what we call about 10 to 1. But then you buy another account of Euro USD at same price, and the full amount of your position turns out to $200,000, but your account balance is still $10,000, but your true leverage is now 20 to 1. So you're feeling good, so you buy 3 more standard lots of Euro USD, Again, at the same rate, the full amount of your position turns out to be $500,000, and your account balance is still $10,000. Your true leverage is now 50 to 1, and assume the broker requires 1% margin. If you do the math, your account balance and equity are both $10,000. The use margin is $5,000. The usable margin is $5,000, of course. And for one standard lot, each pip is worth $10. So in more brighter analysis, you have a balance of $10,000, equity 10,000, use margin, very importantly, 5,000, or your rather usable margins also remains at $5,000, all from your balance of $10,000. So in order to receive a margin call, price would have to move 100 pips, right? 5,000 usable margin divided by $50 per pip. And this would mean that that price of Euro USD would have to move from 1 to 0.900, which is a price change of just 1%. But then after the margin call, your account balance would be $5,000. You lost $5,000 or 50%, and the price only moved 1%. But then let's pretend you ordered coffee at a McDonald's drive-through, and then you spilled your coffee on the lap while you're trying to drive, and then you proceeded to sue win against McDonald's because your legs got bumped and you didn't allow the coffee to get too hot. But then you buy one standard lot of Euro USD, but at the rate of $1. Now the full amount of your position is $100,000, and your account balance is $100,000, which is your true leverage was 1 to 1. But then it just looks like this in your trading account: $100,000 balance, equity of $100,000, use margin of $1,000, and the usable margin of $99,000. So now you really need to pay attention to your usable margin. Yes, not their use margin, because you still have a lot which you can use and maximize much and much more trade potential before you close out on your accumulated profits. So in this example, in order to receive a margin call, price would have to move 9,900 pips, which is $99 worth of your usable margin divided by $10 per pip. Next page, please. This means the price of Euro USD will have to move from $1,000 to 0.0100. Now, in order to be margin called, price would have to move 400 pips. And this means that the price of Euro USD will have to move from $1,000 to 0.96, and a price change of 4%. But then you would have realized an $80,000 loss, and you would have wiped out 80% of your account, and the price only moved 4%. But then you see the effects of leverage. Leverage amplifies the movement in the relative prices of currency pair by the factor of the leverage in your account. Remember, low leverage allows new forex traders to survive, but you need to pay attention to not under appreciating your leverages. Yes, which is why I said always remember you have a look at your usable margin. Now, for instance, you're having a leverage 100 to 1, percentage change in currency price is 1%, and percentage change in account is 100%. 50 to 1, 1%, percentage change in account 50%. 33 to 1, 1%, percentage change in account is 33%. And you have another one, 20 to 1, 1%, 20%. While 10 to 1, you have 1%, and of course you have 10%. So the real sense of this, you just need to understand how you can maximize your leverage potentials and make sure that you use it to maximize as much profit as possible from the financial markets. Next page, please. Now, basically, we are understanding something very potentially good from the market, which is mini accounts. Now, let's say you bought Euro USD JPY and it goes up by 1%, And by the 1% from 120 to 121, that's what I mean. And then you understand the fact that you bought USD JPY and it goes down by 1% also from 120 to 118. And if you trade one standard 100K lot account, there is how leverage will affect your returns. But the more leverage you use, the less breathing room you have for the market to move before a margin call happens. So you're probably thinking, I'm a day trader. I don't need to think. I don't need a breathing room. I only use 20 to 30 pip stop losses, you believe you just had a bad day, and the next day you're feeling good and want to recoup yesterday's losses. So you decide to double up and you buy 4 mini lots of Euro USD. Your true leverage is about 90 to 1, and you set your usual 30 pip stop loss and your trade losses. And your loss is about $120, which is $1 per pip for 4 lots. So you need to pay attention that you just lost 12% of your account, $60 loss per $500 account, and your account balance is now left with $440. So very ideal you take this into consideration while you're moving ahead with things. Next page, please. Now, you just lost 27% of your account. Your account balance turns out to be $320, or you just lost 90% of your account, and your account balance is now $260. But you're getting frustrated. You try to think what you're doing wrong. You think you're setting your stops too tight. The next day, you buy 3 mini lots of Euro USD. Then your true leverage is 115 to 1, and you're losing your stop loss to 50 pips. And the trade starts going against you, and it looks like you're about to get slapped out again. So you should focus on low leverage with proper capitalization, of course. It allows you to realize losses that are very small, which not only lets you sleep at night, but also allows you to trade another day. So we have bills opening of $5,000 account trading, $100,000, and they're trading 20 to 1 leverage. And the currency pairs that normally trades moves anywhere from 70 to 200 pips on a daily basis. So in order to protect yourself, we see tight 30 pip stops. If price goes 30 pips against him, he will be stepped out for a loss of $300. He feels that 30 pips is reasonable, but he underestimates how volatile the market is and finds himself being stopped out frequently. So after being stopped out 4 times, Bill has had enough. He decides to get himself a little more room, understand leverages, handle the swings, and increase his stops to 100 pips. Next page, please. Now, how leverage affects trading transaction cost. Besides amplifying your losses, leverages also have another way of killing you. It's a much slower kind of death though, because you're kind of like dying by 1,000 cuts, but most forex traders don't see it coming, and by the time they notice, it's already gone. And the killer is, I'm talking about, is associated with transaction costs of using high leverages. Next page, please. Now, the higher your leverage, the higher your transaction cost as a percentage of your trading capital. And that is why transaction cost is one of the 6 most important factors when choosing a broker. So if you have a mini account and you open a trade with a 5 pip spread, which equals $5 transaction costs, you look at how the relative value of your transaction cost increases with more leverage. So take a look at leverage, margin required, cost of percentage, margin required, and of course, this is a 5% of your account. So you're having 2:1, 200 to 1, with $50 margin required, 10%, of course, 100 to 1, $100, 5%, down to 5 to 1, we have 2,000 margin required, and cost of percentage as margin required is 0.25%. So that's it. Next page, please. So you never underestimate leverage. Don't get greedy, watch your leverage soon. Most beginners underestimate the potentially devastating damage leverage can wreak on their accounts. So understanding leverage enough to know when to use it and when not to use it is critical to your success. So leverage is a very powerful tool, but both old and new traders use it to destroy their trading capital simply because they take it as a destructive force too lightly or ignore it altogether. So it's a pity, but a leverage. So always keep in mind this words from a famous superhero: great power comes great responsibility, something of that effect. So let's see how it all works. Next page, please. So, anyways, high leverage is a favorite selling point for most forex brokers. They pitch that you can make a huge killing using huge leverages, but also know that you can easily be killed by your huge leverages as well. So, brokers want you to trade with a short-term mindset. Always remember safety first. They want you to trade as much as possible as often. It's the only way they make money. One or two pips are important to them. And the more you trade, the more they make on the spread. It's not in their best interest to tell you to let your trades run longer than the same day. So if you want to give yourself the best chance to succeed, first thing, you first learn to trade profitably without leverage. Play it safe, protect your capital. Forex trading should be treated as a job or business. Don't think of it because brokers allow you to list high leverage with low minimum deposit that you can make quick cash or have that get rich quick approach to things. No, be realistic in your expectations and be willing to properly educate yourself. Okay, next page, please. Position sizing, very important final topic. Now, you have learned a hard lesson about risk management, leveraging. Position sizing is setting the correct amount of units to buy or sell on currency pairs. So actually, we'll go ahead and say it is the most important skill because traders are risk managers, first and foremost. So before you start trading real money, you should be able to do a basic position size calculation in your sleep, or at least after you wake up, and try to trade the NFP report. But finding a position size that will keep you within your risk comfort level is relatively easy. And we use the phrase relatively easy because, before we get our match, we understand first of all account equity or balance. We understand currency pair you're trading on and the percent of your account you wish to risk. We talk about stop loss in pips. We talk about conversion currency pair, exchange rates, and a lot of things like that. Next page, please. Calculating position sizes. So long time ago, back when they're having a lot of newbies in the business, you need to understand your position size will always depend on whether or not your account denomination is the same as the base or code currency. So to make this easier for you to understand, you need to always have your account balance in check at all times, right? In check at all times. Next page, please. Now, account denomination, which is the same as counter currency and the base currency. So always divide the amount raised by the stop to find the value per pip. And as a newbie, it's pretty simple. You should put 2.5 units of Euro USD or less to stay within this risk comfort and with this current trade setup. Now, we are saying that all we have to do to find the value in USD is invert the current exchange rate for USD and multiply the amount of euros we wish to risk. And finally, you multiply the value per pip move by the known unit to pip value ratio, of course. Next page, please. Complex forex position sizing. Now, in this lesson, we'll teach you how to calculate the pairs in which your account denomination is in one of the currencies in the pair currency pair that you want to trade. So account denomination is not in the currency pair traded, but the same as the conversion pairs counter currency. And we are understanding that to find the correct forex position size in this situation, we need, let's take for instance GBP USD, and you're having 1.75, and because the account is in USD, we need to invert the exchange rate to find the proper amount in British pounds. So now we just finished the rest in the same way as the other examples, and finally multiply by the known unit to peak value ratio. So it's best to understand that you don't need to worry enough about this. It's still pretty simple. To risk your Euro 50 or Euro USD or 100 pips, you need to understand that there is a calculation of the position in question along with the position size and every of that. Next page, please. So that's a wrap for today on our webinar series, and I hope we really understood a lot about margin calls, risk management tips, leverages, very importantly, and we urge you to always apply this in your tradings for successful trades. And of course, I, Nicholas, wish you successful trades in everything you do. All right, so see you again next week, Friday. Sorry, this week, Friday.